Let me get rid of this. This was the trade for today. Okay, so I'm gonna start off by trends. I'm gonna write down everything that I've talked about, and then we'll start talking about them. Alright, so this is the stuff that we have so far on this channel, and we're gonna go over all of this. So first, we have trends. Basically, what a trend is when you have a high, a low, a higher high, a higher low, higher high, higher low, higher high. Let's draw these out. So this right here would be considered an uptrend, as we have higher highs and higher lows, higher highs and higher lows throughout the whole thing. And then let's draw the downtrend for you guys. So, alright, so we have lower highs and lower lows, and that's how we define an uptrend and a downtrend. Let's get rid of this. Next, we're gonna go over, actually, we can go a little bit over this in the market. So, let's say you want to draw out this right here. So here, as you can see, we have an uptrend. And we're just gonna go over this pretty quick. I don't want to get stuck in this for too long, but here, as you can see, we have a downtrend right here. So yeah, those are just a few examples. You guys can also go into the markets and mark those out. You guys can also go into the line chart and do it. So next, we're gonna be talking about liquidity sweep. So liquidity sweep basically is when we have right here, we have a high right there, and it gets swept. Market sweeps it, as you can see. You can draw this right here. So that's a sweep on the upside, and then we have a liquidity sweep on the downside. So that's how that would look. If you see something like this on the market, these are actually called equal highs because this one hasn't been swept. Price is more likely to come down to this to sweep this because price does want to gather up all these orders just to shoot higher. So yeah, so that's what a liquidity sweep, and we can go look at a few examples on the market. I'm kind of trying to make this a little quick because I don't want this video to be too long. So let's say we have all these lows right here. So this is a trade I took today actually. So all these lows right here got swept, and then so let's see where we have rectangle, and then we came into this fair value gap, broke structure right there, and I'm going to talk about that next. So we broke structure right there. Okay. So let's talk about, actually, let's go over one more example of a liquidity sweep just so you guys understand it. Okay. So, all right. So right here we have a liquidity sweep on the downside. Right there, price rallies, and then let's do a liquidity sweep on the upside. So see, we might have something right here. Okay, so let's say these highs get swept right here and price rallies all the way down. So yeah, that's basically what a liquidity sweep is. So we have that. Now let's go back to, so next we got that, we got that. So next we have, let's get rid of that. So next we have break of structure. So basically what break of structure is when we it's a switch in market direction. So here we have higher highs and higher lows, and as soon as we get a switch in market direction, let me draw this out for you guys right here. So I'm not going to draw all the highs and lows because I already talked about that, but basically we already know that these are higher highs and higher lows. So if we have higher highs and higher lows, that indicates an uptrend. And if we break past one of these, then that indicates that we have a break of structure. What could honestly happen sometimes is we can have an uptrend and price comes back down here for a liquidity sweep, goes back up, and then breaks structure again, and then comes back to a retracement, and then rallies all the way up right here. So yeah, so basically, when it displaces through, that's when you have a break of structure right there. And we're gonna go over some examples over here, and then basically that's just a switch in market direction. So after that, you would see price go into something and then come back out, and then you'd see price turn into this. So, and then on a higher time frame, you'll see that this was a high time frame liquidity sweep. So that's how you'll end up actually taking trades and stuff like that. You have your third confidence right here, and that's how you can kind of implement everything into that. So yeah. Okay, let's go over some examples on the market. So let's see, we can go over today's example. Let's see. So right here we broke structure to the downside. It was a huge break of structure. We swept all of this liquidity. So as soon as we have a break of structure, we have to consider that it's going to a higher low. So this one came to these lows right here, and then when we finally had this break of structure right here on this candle, let me draw that out for you guys. Broke structure to the upside. So we broke structure right there. Okay, so as soon as we broke structure, what were we looking for? We were looking for highs to get hit. We waited and we saw for, like I said, these two highs are more prominent highs because this one hasn't been swept. So as you can see, this one's still open has orders and stuff. So yeah, so price is more likely to come up here, and then price is going to come back down and retrace. So basically right here what you had was an uptrend, and then you saw market structure shift or a break of structure down to the downside, sweep liquidity, come back up, came down to this fair value inverse. Actually, this is a BPR right here, and I'll talk about that next. So came down to this BPR, came back up, swept these highs, came down to this fair value gap right here, and then as soon as it came down to that fair value gap, came up, broke past this fair value gap, so that we know that it's going to go up, came down to this low right here, and then rallied all the way up into this higher time frame fair value gap that's over here. And then let's go over just a couple more displacements. So here we have a downtrend, and right here we have market displaced through it. Let's go over a better example for you guys. Okay, so here we have market displaced right here, this big candle right here. Let's see. We also had this right here. And then breakup structures are more likely to work on higher time frames. On the low time frame, it does switch back and forth a lot. So I would suggest you guys use this breakup structure for higher time frames. Let's see. So as soon as it does break structure, it looks for it looks for the next low. So say right here we have this breakup structure. As you can see, it displaces down all the way. We have this candle close completely past it. So we have a third confluence right here. Came back into this fair value gap, and then we have price come down to, let's see, we have price come down to something over here probably, but we had price come down, and then right here, as you can see, we had price displace through right here. And as you can see, price came back down to sweep this and went all the way up. So yeah, and then next we're going to be talking about displacement and manipulation. So basically that's the same thing that we were just talking about right now. So right here, price got manipulated, came back down, displacement right here. So yeah, I'm not going to go over that too much. You guys already know. So basically displacement is just a breakup structure, like right here, how this broke past it. And then a manipulation is just a liquidity sweep, like these lows getting swept by this candle. It didn't displace through, it just swept. So yeah, and then next we have an inverse fair value gap, BPR, and other gaps. So we're going to go over that right now. So a fair value gap, I don't really have to go over this too much. It's just a 3-candle pattern with a gap in the middle that price goes into either to respect or to disrespect, and you can use that for trading in your plan for a confluence. So right here, how it got disrespected, I probably wouldn't enter off this just because the wicks are disrespecting it, so it's lower probability. But we do have other fair value gaps, so you have to take that into consideration. Yeah, so you can use fair value gaps for a retracement tool, and let's go on to the lower time frame, and I can show you guys how today's was respected. So, and then I can show you guys inverse fair value gaps and BPRs. All right, so this was today's trade right here, trading stuff. So right here we have where should I start? So right here we have a BPR. Basically what that is when two fair value gaps are perfectly aligned. So we can also count from here to here as a BPR. As you can see, this fair value gap and this fair value gap are perfectly lined up. We can account. Let's see. Let's see if we can find some more. Let's see. You might be able to find, let's say, right here, how that lines up right there. That's a BPR. Price comes into it, goes back out. Then we also have this right here as a BPR. Price comes into it, back out to these highs. And then right here, we have a fair value gap right here. Price comes into it, goes back out. Okay, so that's just BPRs, fair value gaps. And then for inverse fair value gap is basically, so basically it would be using this candle as in price comes back into it. So let's draw that out for you guys. So say we have a trend going, come up, sweep this. Okay, and then we come down and we go into this fair value gap on the other side. So we come into this upward fair value gap instead of the down fair value gap. So it's not used as a retracement, but it is stronger because it's an inverse fair value gap. Even if we don't have any gaps on this side, if we do, then it's a BPR. If we don't, then it's just a regular inverse fair value gap. So it would be like marking this out. And it would be like if price went out of this, came back in, and then rallied. So we could have used that as well. So that's just inverse fair value gap. But we had so many right here. So many fair value gaps and BPR. So we didn't need it. But where are we at? Alright, so I think this might have deleted. Oh, it's actually right here. So alright, so we're done with fair value gap. Oh, actually, let me talk about one more thing. So we also have these gaps that we use on when market closes and then opens again. We have that gap that is used as well, and that I use for ICT. So right here at 3, so market close right here. So what you'd basically mark out is market close right here, and then it reopened right there, and you can mark that out as a gap. As you can see, price didn't come up to it at that time, but let's see. So right here, the same thing. So price closed, and then let's wait for this to load. Alright, so right here, price closed and then opened. And as you can see, price comes into it a lot. I just use this kind of just as a reference of where market is trying to go. And you can also use equilibrium, and I'll talk about that tomorrow. I actually forgot to make a video on that, so I'll talk about that tomorrow. Yeah, so those are just other gaps that you can use that price kind of draws to, and you can just, it's from my time, it's from, let's see, right here. A good example would be right here. So let's go into a lower time frame. Alright, so right here we have a good example. So you go on to the 1 minute, and then what you want to do is you want to go to the close. So at 158, 159. So right here, market closed, and then market opened right there. We mark it right there. We don't really, the wicks aren't too important. You don't have to go by the wicks, you go by the fullness of the candle. So market opened right there, and you want to just drag it, or you can also just go into style and then extend to the right, and then yeah, and then you can use that, and that basically just marks out like what you can use. As you can see right here, we marked that out, and as you can see, today's trade came up into there twice. So yeah, you can use that as just kind of a draw on liquidity as well, and the market keeps bouncing off of it. So yeah, and then next we have order blocks and breaker blocks. So let me draw that out for you guys. Basically, what a order block is the move up of the liquidity sweep. So let's say we have an uptrend. Let's say price comes down to sweep this, and then all right. So I'll show you guys both right here. So basically, let me mark out the liquidity sweep first. So right here we have the liquidity sweep, and then right here, if we mark from the high to the low, we have the order block. So right here we have the order block, and then if we mark from the high to the low, the retracement, this is the breaker block. So that would be the breaker block. So let's just go over the market and find some examples. So right here we have an uptrend. Price came down to sweep liquidity. So what do we know? We'll mark out from the high to the low. So that right there would be our order block. There. Price came out, came back in, broke out of it, and then price, yeah. Sometimes it ends up coming back in, sometimes it doesn't, but I probably wouldn't have used an order block in this because we had so many other third confluences that are better that we could have used in here, including the BPR. So, and then for the breaker block, we have the down move. So we have the up on the top, and then we have the bottom right here. Right there. So yeah, and then let's find some other examples. So we can use this as an example. So right here we have a order block. Price didn't come into this order block because it ended up respecting this fair value gap right here. But if price would have came into this and back out, that would have been your entry right there. We also have this breaker block right here as well. So breaker block is the up move, and we can show this on the line graph. So right here we have the down move. So we have the down move right here is the order block, and then right here we have the small up move. Small up move before the order block would be the breaker block. So yeah, yeah, and you guys can go on the market and mark these out yourself, and you guys can go to my videos and learn on depth how do you do all this. It's just kind of just a quick summary, just to go over what I've taught before I actually start taking paper trades with you guys. So yeah, so that's just me going over just a summary of what videos I've made. That's just covering all the 7 things I've talked about. And I'm probably going to make another video on equilibrium and anything else that I missed. So, yeah, so that would be my next video right there. Yeah, thank you guys for watching. Please like and subscribe.